welcome to the Mutual Fund Show. I'm Niraj Shah, and we're going to be talking about the aspect of the market that intrigues most investors in the retail fraternity very, very closely. Actually, two of them, mutual funds and mid caps. Obviously, on the Mutual Fund Show, we talk about mutual funds, but we talk about the mid cap end of the market since everybody seems to be saying that, oh, the mid caps and the small caps are overheated. But here, we have a very interesting time, or rather, as the saying would go, maybe don't time the market. HSBC Asset Management, at the launch of the Midcap Fund, HSBC Midcap Fund, have put out the tagline saying invest in the early signs. Now, that's the very interesting and the intriguing part of this show, which I'm going to get in Tushar Pradhan to talk about. He of course needs no introduction. And Tushar, we talk about the fund and the NFO in a bit, but I want to start off with this tagline: invest in the early signs. So what's the juice out here? You guys believe that we're in the early throes of a multi-year mid-cap run?
Well, actually, the early signs relate to the business opportunity. It's not necessarily about the market. So essentially, what we've seen is that any business which goes through a phase of growth, especially when it becomes a mid cap, the next phase of growth is when it will potentially travel all the way into becoming a large cap. But by the time it's a large cap, I think probably two-thirds of the journey is over. Not that large caps don't make money, but as we all know, the percentage returns from then on will be more in line with the broader indexes, much larger indexes. But when we look at the early signs, we're talking about identifying potential companies which may actually cross the threshold and become large caps. So that's really the universe that we will be focusing on. And I think that's really what the tagline means. It's nothing to do with the market or whether it is early or late, because markets are cyclical. They will always be either up or down or not, somewhere in between. So I think it is more to do with the stage of growth of the business that we're talking about. And if you can lock on to an early stage, the journey can be very, very rewarding.
Okay. So, okay, let me try and rephrase my question, Tushar. What's your what's your thesis about where the broader end of the market seems to be currently? I know you mentioned that markets will always be up or down or somewhere in between, but where my question is coming from is that starting 2018, the broader end of the market was decimated, and people who are looking at the glass half full are saying that if you look at the broader end of the market, it's merely retraced some of its lost glory. And some who are looking at a glass half empty are saying that the run up has been so stupendous and so sudden and steep that it calls for a correction because valuations can't sustain here. What are your thoughts at the broader end of the spectrum?
So I can see a lot of questions there. So it's
Yeah.
not an easy answer there. But yes, the headlines do indicate that by any metric that we look at, the valuations appear to be expensive compared to either history or averages or whatever. But I think what we're missing out is when we look at a valuation parameter, we have to look at the price divided by the earnings per share. Now, you have to be a little mindful of what has happened. First of all, we've been actually looking for this earnings growth for the last 5, 6, or 7 years. We are saying next year is going to be where the earnings growth is going to come from. But in the interim, what we have actually been given is a very tepid growth of earnings over this period of time. And what has that actually made into is that after the COVID situation developed in 2020, the earnings not only did not go up as much as what we were expecting, but it actually collapsed. So essentially what we're treating the valuation metric is two different orbits altogether. So the valuations currently, what the market are trying to tell you, reflects the potential of the businesses. It's not reality as yet, because the market value generally discounts the future potential of a business or a set of businesses, or for this matter, the market. Now, what has happened is we always need a crisis to kind of jumpstart. If you remember, there were many attempts in the past to jumpstart the economy, but they all failed because the demand was just very, very tepid. We were undergoing very, very average rates of return. GDP growth rate was not getting accelerated for various reasons. Now, this kind of jumpstart actually has come by way of the COVID situation, where we just stopped. So as you know, every engine when it stopped, it has to get jump started. So for that reason, suddenly all of the things which in the past we were worried about, capex, demand, supply chains, all of those things that we were worried about, all now have started to get aligned. So in a sense, this very forced, I would say, putting down of demand for a year will have some impact. And once this machine starts to roll on, then you will see some secondary impacts as we go along. So I think it's very difficult to dismiss this valuation on the headline and say, look, we are expensive. What are you talking about? But I think if you start to see those two lines as we move about, then I think it starts to make some sense. The faith has to be on the sustaining of the earnings growth trajectory and the truly coming out of the Indian economy, as we call, and we've been calling for some time, in terms of taking its place, in becoming one of the most sustainable growth economies in the world. And I think that is what, if you believe in, then the current valuation can clearly be explained. So it depends on where you put your faith in.
Okay, and a question as a follow-up to what you have so beautifully explained, Tushar, is whether you believe that the hearty gains would be made at the broader end of the spectrum, because clearly you are saying that catching the business cycle early is great, and maybe this new business cycle, if you look at the government moves or what have you, it is benefiting a lot of very competent, but not necessarily only the very large cap companies. A lot of mid-sized companies are sector leaders, and they are coming out and announcing capex and talking about stupendous earnings growth. So do you believe the broader end of the spectrum is poised to give very good returns if you get the calls right?
Yeah, I think, again, I want to make a distinction that we don't want to say that we are timing it in any way so that, this is the right time to invest in mid-caps. We are talking about mid-caps as a category. And I think when we identify those companies, which I mentioned earlier, when they catch that growth phase, now whatever the market does during that time, you can clearly see these companies emerge as market cap leaders because of the strength of their business model. And it has nothing to do, with the market in general. It is something to do with their intrinsic ability to grow very fast in any time. Say, for example, I don't want to name names, but I'm sure we all remember that there were so many of these companies in the past 3 or 4 years where the market has remained fairly tepid. But the kind of returns that we've seen in these businesses are upwards of 3 times, 4 times, 5 times in just a short period of between 3 to 4 years. And I think that is really where the focus of the mid-cap product needs to be, and the focus of the investor who buys the product. It has nothing to do really where to say, well, as a whole, are all mid-caps expensive? That's really not, looking at the story as we see it. If we can identify these potential businesses, then whatever the markets do, the markets will do whatever. I mean, there have been times when earnings have been very robust, but a third party event or something geopolitical causes the market to crash, and suddenly people say, oh, it's just so cheap, but nobody wants to buy because of the geopolitical situation being so strong in your face that you're unwilling to kind of invest. So there is a gap as we perceive it between what the market is telling us and what the businesses do. The businesses have to do what they have to do. So that's why I wanted to point that distinction, that mid-caps has everything to do with identifying that early sign of a multiplier of a business which potentially can become a large cap, and then holding on to them for a period of time, because it doesn't happen overnight, and it may not happen in the next market rise either, or for that matter, you don't write them off in the next market fall either. It's something to do with not immediate gains, but it's something to do with the longer term potential of these businesses.
Yeah, fair call. So, okay, let me not try and say that this you are trying to say that this is the best time to enter into the markets or the mid cap space from a timing or a level perspective, but from a business cycle perspective, this might actually be as good a time as any. Is that the larger call? And therefore, if people invest and wait it out for a slightly longer period of time, then the gains are more likely than not to happen.
Absolutely right. I think you paraphrased it perfectly. What
Okay,
I mean
sorry
to say
for paraphrasing it.
the point is, when we put these mid caps together, people will always point, oh, but that mid cap is trading at 50 times. But that's not what essentially, that may be attractive to me right now. But there are mid caps, which may or may not be at that valuation, but I see that potential going forward. And when the market collapses, the 50 multiple with no story is going to collapse, and with it the market. But my company that I have chosen, and if that actually satisfies the promise, that's first of all not going to fall as much as the 50 multiple guy. But it is also going to sustain the earnings growth over the next 2-3 years. And then when that rise happens again, and who knows, it might take 2-3 years to get there, you've got a winner. So that's really where the story lies.
Because now we may not have the chart, but the HSBC's docket contains this very wonderful distinction about how in certain cases, mid caps, the returns generated before inclusion in the Nifty 50 for a particular set of mid caps or a particular mid cap were 263%, and post Nifty 50 was 81%. So which is why probably the line of how mid caps need to be tapped at an early stage of the life cycle. Tushar, not strictly a mutual fund question, but I'm just broadly asking you, do you, as you sit where you are perched, see a lot of themes where the probability of a multi-year growth cycle for that sector and good companies within that sector is possible? Or is it restricted to a select few?
No, I think when we talk about the India story, and we've been talking about the India story for quite some time, but the India story has changed in nuances, right? So the India story has not remained that one story. Whether it was IT some years ago, whether it is now the specialty chemicals for the diversification of the supply chain story now, or whether it is e-commerce, whether it is aggregators, whether it is these financials, I call them quasi-financials because they may be portals who actually democratize finance rather than actually lend. So the lending businesses versus the intermediaries, whether the asset managers. I mean, we're talking about various phases of the India story. And as we develop as a nation, as we develop as an economy, there will be so many more of these opportunities, which today maybe even not be visible. They may not be of my portfolio today because they don't exist. But can this potentially be something very different than what we were ever seeing in the past? Clearly, yes. I mean, the kind of range of opportunities that we see today, for example, are simply far more than just one or two sectors that currently we may like. But very clearly, some of these other businesses will develop into something much more. So whether it is electronic components, whether it is greater offshoring, whether it is, I mean, you name it. I mean, there are so many things which far remain unexplored as even now. That has the potential for these businesses to grow.
Sorry, so therefore it's not the market timing but the business cycle timing that has led you to launch this fund, the HSBC Midcap Fund. What are the characteristics? Why should people look to utilize this fund to make their investments?
So it's simply, one of the things that we've identified is, quality of business, which means that we first of all focus on what sort of business it is. Forget about the valuation, it comes later. But is this a business which we believe over the next 3, 4, 5 years is going to deliver on its promise? And then that's the research that we do in terms of understanding this. Quality of earnings. Are these businesses making the right sort of quality? So I'm sure you know how the quality can be disseminated, and we understand that this is the pure asset turnover led earnings that we really look for, the higher ROE, the sustainable ROE. Quantum of earnings, because clearly the market cap is a function of how much you make as well. So that's the fourth cue that we look at. And of course, the quality of management. So I think once we kind of have a fairly, well-defined framework, then it's easier for us to identify these opportunities as well. If they tick all the 4 cues, that's a potential inclusion in the portfolio. So what we are saying is we have a broad spectrum. We are not focused on any sector. In fact, one of the things about the mid-cap index itself is it's a lot more diversified by percentages. So it's not concentrated, as some of the larger cap indexes are, that they are concentrated in a few sectors and they remain concentrated. So the shift in the concentration happens, but suddenly, the focus again shifts very largely to one sector or two. But the mid-cap index actually is a far more diversified index, which means it gives you so much more opportunity, much more broader spectrum to kind of pitch your bets in terms of where they are likely to go in the next 5, 6, 7 years.
Okay, well, I believe it's open for subscription as we speak, right?
Already, it opened on the 6th, and it will remain.
Okay. Well, we wish you all the best for the NFO. Thank you so much for speaking to us today and giving us a sense of your thoughts around the broad end of the spectrum.
Thanks a lot.
All right, viewers.